Host, make me the host. Can you make me the host, please? Okay, thank you. Hi guys, good evening. You okay, everyone? Okay, I changed my laptop, so there's a little settings that I have to do. Just give me a second here to share my screen. Right, doesn't this work? Hemant, can you make me the host, please? Hemant, can you make me the host, please? Hemant, can you make me the host, please? Okay, thanks. Okay, right. Hello, everybody. Welcome to another session of the revision game plan hosted by BPIM. And last week we saw how to work on a consolidated balance sheet question. Today, as per most of you requested, okay, you wanted to know, okay, if you get an income statement, consolidated income statement and consolidated balance sheet put together, how will you tackle a question? So that was what was requested. So as per the request by students, what I'm going to do is I'm going to work on a consolidated income statement and a balance sheet question. But before everything, everybody, guys online, can you all hear me? Can you all see me? Can I get a hi? Can you all hear me? Can you all see me? Can you all hear me? Can you all see me? I want everybody to respond. So, I want everybody to respond. Okay, I'm getting messages that the link is not connected. Give me a second. Let me share the link for the students. Right. Superb. Can we start? Okay, what shall we do? Okay, we have a new learning in this, so probably okay. Okay, we have a very good question. We have a very good question. There's a lot of learning in the question. So we have consolidated P&L and balance sheet both in this question. Polestar, okay? Guys, get it right. It is Polestar, nothing else, okay? So please go to Polestar on your question, on your revision kit if you have. P-O-L-E, okay? Get it right. Okay, super. Everybody, you're in with me? Yeah? Right, super. Guys, this question is very effective, has a lot of learning. There's a lot of learning point in this question. So we're going to see how to work on a question like this in the exam, okay? I'm going to be a bit more quicker this time than last week, because right now, we've come to a point where, we have technically mastered consolidation and we know the steps as well. It's a matter of applying, getting things in place. Okay. What is the requirement? The requirement is very simple. Prepare the consolidated statement of profit or loss for Polestar for the year ended 30th September 2013, and prepare the consolidated statement of financial position for Polestar as at 31st September 2013. In total, consolidated P&L, consolidated balance sheet. You've been tested for approximately how many marks? You've been tested for? Okay, what happened? Wait, two. Shall we start, everybody? Shall we start? Okay, super. As always, guys, you need to know my steps. My steps are not gonna change. Whatever said or done, steps remain the same. Okay. Before I start, you take at least 5 minutes, read the question on your own, and then we will start together. While reading the question, please try to connect with everything that you've studied so far, because I'm gonna go back, connecting everything that we've covered. So take about 5 minutes, a good 5 minutes, try to understand what your examiner has said. and then let's start together. Okay, your time starts now. Okay, guys, everybody, let's start, right? I hope you have gone through the question. Like always, we are not going to complicate a lot of things. All what we are going to do is we are going to go to our Excel sheet. Now, guys, you know, right? We will be working on the question on a sheet on a platform which is very similar to our Excel. Okay, so if you can practice yourself on Excel also, you're fine. Okay, nothing to worry. Okay, wait. Okay, now technically, guys, you're going to work on something like this. Okay, now all these questions we have already done, right? That is, guys, if you have been my student throughout, we have done. But if not, don't worry. During the revision, we are trying as much as possible to finish more questions. Okay, super. Now coming back, let me open up a new tab. It's gonna be Polestar. Right. Simple. I have the question here. And then of course, I'm gonna start answering. Okay. In the real exam, your answers will be on your right side. Your answering sheet will be on your right side. Your question will be on the left side. Don't worry, by next week, I'll show you how it looks like also. Okay, right, super. As always, guys, any question, consolidation, I want you to leave about 50 lines. You come right to the bottom. Come right to the bottom, say workings. Workings, whatever we studied last week in terms of the steps will not change. Workings and working number one always will be group structure. Are we clear, everyone? Super. Now, even I did not even read the question, right? But it's just that you need to know my steps. Working one, group structure, and then of course working two, going to be reserves, and then I go back, do my line by line addition. That's not going to change no matter what. On 1st April 2013, your year end is 30th September 2013. Okay, what is the point that you need to keep in mind? It's a media acquisition. You're acquiring on 1st of April 2013. Your year end is 30th September 2013. How long has it been since you acquired? It's been 6 months. April, May, June, July, August, September. 6 months since acquisition. So it's a mid-year acquisition. All what you have to do is you have to time apportion revenue and expenses of the subsidiary when you do the P&L. Keep that in mind. Super. So 1st of April 2013, Polestar acquired 75% of Southstar. There you go. So Polestar acquired 75% of Southstar. Polestar is the parent subsidiary, and how many percent NCI? 25% NCI. Are we clear? No problem there. Okay. Once you take that, you know group structure, what is going to be your second thing? W2 is going to be your reserves. You don't even have to read the question. Just do whatever I have asked you to do. Reserves, you have Polestar brought forward, and then Southstar. Makes sense? Under reserves, what do I have? Retained earnings, and then retained earnings are done. And then I leave some line, I say revaluation. Are we clear? Are we clear?
Yes.
There you go. So going back, I want you to give me the retained earnings figure and revaluation reserves. Where do you get it? Where do you get it? Where do you get it? Anybody? Retained earnings and revaluation reserve. How much is it? 28,500 and 12,000. 28,500 and 12,000. Let me go. Retained earnings 28,500. That's right. And 12,000. That's right. I need it as at the year end. Now keep that in mind. So 28,500 and 28,500 and 12,000. There you go. Done. How much is my revaluation? 0. Brought forward revaluation 0, 0. Are we clear, everybody? Yes or no? Everybody out there, do you understand? Are we clear? Everybody out there, do you understand? Superb. We're done. Now what do? We go to the question. While reading the question, any adjustments, I'll take it as workings, but I have to do my line by line addition. Keep that in mind. So even before checking any of this, what I'm going to do is I'm going to do my line by line addition. Okay, guys, now you need to tell me, am I going to start with P&L first or balance sheet first? Balance sheet. P&L or balance sheet? P&L and balance sheet? Okay, Salma says balance sheet, so let's start with balance sheet, no problem. We can start with balance sheet and then do the P&L, no problem. Okay, right. I'm going to go to the top and you're going to give me figures for my Polestar. Okay, everybody, Polestar group of companies, consolidated statement of financial position as at 30th September 2013. Are we clear? Are we clear? What do I start off with? Everybody, assets. Below assets, I've got non-current assets. Okay, can I get the figures, please? What do I get first? How much is PPE? 41,000 plus 21,000. 41,000 plus 21,000. That's done. And then investments. Investments. How much is investments? 30,500. 30,500. 30,500. 13,500. Just 13,500. That's it. Okay. Investments will result in goodwill on acquisition. I need to calculate that, and then I'll have investments in associate. Even if you have associate or not, no matter what, just put it. That's okay. Are you clear? And then I have current assets. Under current assets, what do I have? Entirely, do you have current assets? Yeah. 19,000 and 4,800. So equals 19,000 plus 4,800. Clear? Therefore, I get my total assets over there. Everybody with me? Yes or no? Everybody with me? Yes. Yes. Everybody with me? Yes. Okay. And then what do? My equity. Under equity, what do I have? Share capital. How much is share capital? Always parent. 30,000. And then? Well done. Consolidated retained earnings. In the exam, please copy paste. How much is consolidated earnings? Super, have to calculate. And then? Consolidated revaluation reserves, and then NCI. Are we clear, boys? Everybody? Let's keep going. Keep on with the flow. I've got current liability. I don't have non-current liabilities. See? Okay, roughly. So current liabilities. What do I get? 15,000 and 7,800 equals 15,000 plus 7,800. And there you go. I have my total assets. Sorry, total equity and liability. Total equity and liabilities. There you go. We will get prayer break. Yeah, prayer break time. I'll give you in about 10 minutes time. I'll give you prayer break. So isn't this mid-year acquisition? They're acquiring on 1st of April, right? Yes, it's a mid-year acquisition, but when it's a mid-year acquisition, you only apportion revenue and expenses. You don't apportion the balance sheet because balance sheet is prepared at a point in time. You prepare balance sheet for the year ended. So balance sheet, you don't have to time apportion. Are we clear? Okay, super. Now that I'm done with my balance sheet, I can start doing my P&L. So post a group of companies consolidated statement of profit or loss for the year ended 30th September 2017, right? 2013. Okay, I'm sorry. Okay, it's It's 2013. There you go. That's done. So for the name, we get marks, right? Yes, yes, to give the heading, right? You get marks. That's right. But you don't get 20 marks for that, okay? Going back. Right, let's get our revenues right. Like everybody, look here. Revenue. How much is my revenue? 110,000 plus 66,000. Clear? Okay. Equals. Look here, look here, look here, look here, look here. 110,000. 110,000 plus open bracket 66,000 into 6 over 12. Are we clear? Are we clear? Minus cost of sales. How much is the cost of sales? 88,000 plus 67,200 into 6 over 12 plus, hold on, equals 88,000 plus open brackets 67,200 into 6 over 12. Therefore, you get your gross profits. And then what do you have? Operating expenses. 8,500 and 4,400 equals 8,500 plus open brackets 4,400 into 6 over 12. Clear? Yes. PBT and then tax. 3,500 plus 1,000, but it's a positive 1,000. So there is a tax relief. So minus 3,500 plus 1,000. So minus 3,500 plus 1,000. Okay. Into 6 over 12. Exactly. So equals minus 3,500 plus 1,000 into 6 over 12. There you go. Are we clear? Done, done, done. Line by line addition. Done. Now, guys, everybody, do you understand the starting? This is the starting. You need to start somewhere, right? This is the starting. Do you get it? Do you get it? Do you get it, everybody? Okay, can we start? Now, I have put the structure. Now, the structure is done. Now I need to start adding the workings. Now, always structure. Now, you know, structure is entirely done. Now that's the beginning. In the exam, you're not lost. You know, okay, this is where you started. So I want you to follow that pattern. Okay, brilliant. Let's get going. Start reading. On 1st April 2013, Polestar acquired 75% of Southstar. Southstar had been experiencing difficult trading conditions and making significant losses. Does it matter to us? No. Go further. In allowing for Southstar's difficulties, Polestar made an immediate cash payment of only 1.5 per share. Does it matter to us? Figures, yes, that's an investment cost, my dear. That's relevant. In addition, Polestar will pay a further amount in cash on 30th September 2014 if Southstar returns to profitability by that date. Is that relevant? Yes, it is relevant. The fair value of the contingent consideration at the date of acquisition was estimated to be 1.8 million, but at 30th September 2013, in the light of continuing losses, its value was estimated to be only 1.5 million. The contingent consideration has not been recorded by Polestar. Overall, the directors of Polestar expect the acquisition to be a bargain purchase leading to negative goodwill. Okay, volume, massive volume of information, big, about 10 to 12 lines, in the exam, you have to go through. But there is nothing complicated if you know what they are trying to say. They are saying, yeah, they are making losses. Okay, we don't care. But in allowing for such difficulties, Polestar made an immediate cash payment of 1.5 per share. What is that? Investment cost. So forget about everything. We spoke about in the revision class, we spoke about what? Investment cost. So in the class, we spoke about investment cost. Investment cost, when an entity acquires another entity, how many investment costs can you have? 3. And what is this? The first, what is it? Immediate cash payment. There you go. Now, what is the immediate cash payment? They are paying 1.5 per share acquired. How many shares does a subsidiary have? A subsidiary has, there you go, 12,000. How many percent are you acquiring? 75%. Okay, very simple in the exam. Equals 12,000 into 75% into 75% into 1.5. Now, guys, you don't have to show this separately. You can just show it there. That's okay. Your examiner is required to go to that cell and see what it is. So please don't waste time. What would it be? Debit, investment cost, and then credit, cash, cash. Done. That's it. Nothing to worry. Let's go further. Take it easy. Okay. In addition, Polestar will pay a further amount in cash on 30th September 2014. You're going to pay a further cash. So that's going to be what? Number 2, deferred payment. Studied or not studied? Studied. What do they say? We'll pay a deferred payment of in cash on 30th September 2014 if Southstar returns to profitability by that date. If this company returns to profitability, but does that matter? Irrespective of that company coming into profitability or not, I have told you, we have to recognize. Probability of payment doesn't matter. Measurability is satisfied, you have to recognize. The fair value of contingent consideration at the date of acquisition was 1.8 million. You thought you're going to pay how much? 1.8 million is your deferred consideration. 1,800 is your deferred consideration. Meaning you're going to pay. If you're going to pay, what do? Debit, investment cost, credit, liability, deferred payment, correct? Credit, deferred payment. Sorry. There you go, credit, deferred payment. Straightforward. Hold on, go further. The fair value of this contingent consideration at the date of acquisition was estimated to be 1.8 million, but at 30th September 2013, in the light of continuing losses, it was valued only at 1.5 million. Okay, you thought you're going to pay 1.8 million, but the company is making losses. So now you estimate it to be 1.5 million. Hold on. Working for. Listen, look here. You thought you'll pay how much? 1.8 million. Hold on. They also say this 1.8 million was recorded or was not recorded. They say The contingent consideration has not yet been recorded, meaning the immediate cash payment is recorded. So this you have to record, no? So you have a liability to record how much? 1.8 million, 1,800 that you have to record, no? Okay, now we'll go and record that. Debit investment cost, go to investment cost. Let's go to investment cost, investment. So investment will go up by how much? 1,800. Clear? Are you clear? And then I have a liability to pay. How much is my liability? Plus 1,800. So I have recorded it. That's the first thing I had to do. Now, that is done. Now what they are trying to say, look, we thought we will pay 1,800, but we are going to end up paying how much? 1,500. Meaning a reduction or an increase in our liability. A reduction in liability. Think, a reduction in liability. Okay, I told you I'll pay you 2,000. Now I'm paying you only 1,500. Meaning, am I making a gain or a loss? I'm making a gain. A reduction in liability is a gain. An increase in liability is a loss. A reduction in asset is a loss. An increase in asset is a gain. So technically here, working number 4, there is a reduction in liability. Are we clear? Meaning my fair value I thought was 1,800, but my actual year-end value is how much? 1,500. Gain of how much? 300 gain. Are we clear, everybody? Are we clear, everybody? Are we clear?
Yes.
Okay. Now, look at the way I am going to account for it. Okay, everybody, your attention. I want your attention, everyone. Okay, okay. There is a gain. So obviously, parents' retained earnings is going to go up, yes or no? Parent is not going to pay that amount, no. Now parent is going to pay less. So gain, DP, deferred payment. How much is the gain? 300. This time I will add. Look here, let me finish. Let me take. Hold on. I'll give you time. 300, understood? I go to the top. My liability is coming down, right? So this will come down by how much? Minus 300. Now if you take my P&L, obviously my expenses are going to come down, right? So technically, from operating expenses, minus 300. Are we clear? Nothing. You don't have to, right? Are we clear? Guys online, are we clear? Everybody, I want everybody to respond. Now, okay, there's a question. From investment cost, will I not deduct? Obviously, technically, I will take whatever I'm taking to goodwill will be deducted, right? So, logically, my investment cost will come down. To goodwill, I'll take. Why is it deducted from operating expenses? It's deducting from, I'm deducting it from operating expenses. Come on, it's a gain. So, if my expenses come down, my profit will go up. You understand? Okay, understood. Thank you. Deferred payment. Look, I have a deferred payment to make 1,800. I debited investment cost. I credited deferred payment. Done. Debited investment cost, credited liability. And then there's a reduction in my liability. Reduction in liability is again, I amended my liability. I brought it down. I added to my retained earnings 300. There you go. Here, I added 300 and then my expenses I brought down by 300. Understood? Okay. Now, guys, I'm going to give you the break. Don't worry. I'm going to give you the prior break. I understand. The contingent consideration has not yet been recorded by Polestar. We recorded it. Overall, the directors of Polestar expect the acquisition to be a bargain purchase leading to negative goodwill. Okay, I will explain that point after the break. Okay, take your break, but that entire point is covered in terms of numericals. A 10 minutes not a 10 minutes, 5 minutes quick break. It's 7:16. Be here by 7:21. Okay. Quick break and be back. Bye.
Find a home appliance with guaranteed photos. AlivuPro.com. Enjoy fast dispatch and low energy. This is what my creative process looks like. And how I bring my ideas to life is the artist. Let's go. Speak to you in a second. Imposters can talk to each other, and one of them is a clean nut bodies. Whilst the other is discuss tactics. So I've killed over here, clean up this body. No one's allowed to move for about 10 seconds. Who's going to move? Someone's going to move. So, oh, Black Betty, where I am. Oh, what? Look what we just said. Yeah, nice one, bitch. Stay still, you bum. Oh my god, I didn't listen. I moved straight away. I'm so done. I'm so done. You all went. No one moved for the first 10 seconds. Everyone moves. What's wrong with people? Hello? Hello?
Is that? Get online? You there? Get online, can we start? Okay. Overall, the directors of Polestar expect the acquisition to be a bargain purchase leading to negative goodwill. Now, guys, if the parent pays money to the subsidiary above the net assets value, that's a premium. Then there's goodwill, positive goodwill. But let's say the net assets of a company, was 1 million, the parent pays 1.5 million, then there's a premium. 500,000 is a premium. Goodwill. Now let's say the value is 1 million, but the parent pays only 800,000. Okay, now why would a company pay less than the value of net assets? They will pay a lesser amount when the company is not doing well. When the brand is not reputed. There is a problem with the brand. Continuous losses. So because of that, they can pay a negative, reduced amount than a premium. When you pay a premium, it's positive goodwill. When you pay a reduced amount, it is negative goodwill. In other words, you are bargaining a purchase. You bargain and you get the amount at a lower price. In that case, when you're getting at a lower price, are you making a gain or a loss? The buyer is making a gain. The parent is making a gain. Forget about the seller. We don't care about the seller. Because the parent, right? So keep that in mind. Tabish, look here. And let's start working on the question. Okay. At the date of acquisition, the fair value of South Star's assets were. Are you trying to balance the question, Tabish? No. You will not. You will not balance. Look, when I look here. At the date of acquisition, the fair value of South Star's assets were equal to their carrying amount, with the exception of a property. Okay, everything was equal to the carrying amount except a property. What are they trying to say? You should know by now. This had a fair value of 2 million above its carrying amount and a remaining useful life of 10 years at that date. All depreciation is included to cost of sales. They are talking about a revaluation. Okay. Nothing doing. W5 revaluation. But when is this happening? At acquisition. So don't forget AQ. It's relevant for our goodwill. How much is it? 2 million. So 2,000 revaluation. Okay. Keep your pens down. Look here. I have a 2,000 revaluation gain. No, my dear. Look here. Now, what do I do first? I go to BPE. My BPE is going to go up by how much? 2,000. Simple as that. And then I have a revaluation gain. Correct? I go to my revaluation gain account here under reserves. There is a gain of how much? 2,000. Well done. Super. HRI. That's it. Are you clear? And then they say there is a remaining useful life of how much? 10 years at that date. All depreciation is charged to cost of sales. Now what do you have? Depreciation. Okay, there you go. W6 depreciation. How much is the depreciation? You have to calculate. So 2,000 equals 2,000 over 10. That's it. No, it's a 6 months acquisition into 6 over 12. 100. Don't miss that. You need to be very, very, very careful. Okay, look at the way I adjust now. Retained earnings, depreciation, minus 100. Done. And then PPE should come down by 100. Lovely. I go to cost of sales. Add or minus? It's a cost at 100. That's it. Are we clear?
Yes.
Easy as that. Nothing to worry. That's done. Working is done. Entirely done. Nothing to worry. You should understand. Because you understand, right? The working is entirely done. Nothing to worry. Okay. Let's keep it. Let's keep it simple. That is done. We go forward. Polestar. Who is Polestar? Parent or subsidiary? Parent. Transferred raw materials at their cost of 4 million to Southstar in June 2013. So parent is selling goods to subsidiary at a cost of 4 million. Southstar subsidiary processed all of this. So they are processing all of this, incurring additional direct cost of 1.4 million. So probably it can be where you can be where we have acquired a processing plant. Parent has acquired a processing plant. Probably in Sri Lanka, what happens is probably by the Prima, they require feed, right? For their hens, they require chicken feeds, right? Now, when they require chicken feeds, they can probably recently they set up a plant in Eastern. I'm not very sure about where exactly. It's a processing plant to get the feed. How do you get the feed? Feed is generated through the waste itself. Now, chicken waste, the wings and skin and everything, the waste is there, right? It is processed. It is actually processed and converted into feed and sold back to Bairaha. So probably Bairaha or Prima, what they can do is, okay, fine, they can acquire this. So technically what's happening, Polestar transferred raw materials at their cost to 4 million to Southstar in June. Southstar processed all of this, incurring additional direct cost of 1.4 million and sold them back to Polestar. You understand my point? So in other words, working 7, it's going to be what? URP. Oh, hold on. Give me time slide. Look, hold here. P sells to S. And then S sells back to P. Look at the way it's connected. So when P sells, P is selling for how much? 4,000. And then it is processed and sold them back to Polestar for how much? 9 million. So when parent subsidiary sells, it's selling for 9,000. So P is selling for 4,000 and S is selling back for how much? 9,000. In other words, total sales between both party is going to be how much? 13,000. Are we clear? In other words, what is this 13,000? Intergroup sales. What do you do with intergroup sales? Eliminate it. There you go. Hold on. How do you eliminate? No. No, intergroup sales from revenue and cost of sales. We already studied this. Nothing new. Eliminated. Are we clear? Stop. And then what do they say? Technically, guys, it's URP and intergroup sales, okay? Look here, I'll give you time plan. And then they say, at 30th September 2013, Polestar had 1.5 million of these goods still in inventory. There were no intergroup sales. 1.5 the parent had in inventory. Since 1.5 is going to be your stocks, which is not sold to third parties. Unrealized inventory, URP. So how much is that? Technically, URP is going to be on 1,500 worth of goods inventory. But what is your margin that you're keeping? At what margin are you selling? At what margin are you selling? Let's see who gets it right.
4 plus 1.4.
100 doesn't have to be time apportioned, my dear, because 100 doesn't have to be time apportioned. It's a transaction. So you take the total. Since just because it's at acquisition doesn't mean you have to do it. You get my point? Come back.
The 4 million plus 1.4.
4 million plus 1.4.
And then 9 million minus
9 million minus
the 4 million plus 1.5.
5.4.
66% margin. 62, 61. 61.
Percentage, please. What is the percentage? 62% is someone. Someone else is calculating 62. Let's see. Anybody? %.
4 plus 1.5. 66.
How many percent? 40%.
60%.
40%. 40%. Let's see. Okay. Now, guys, look here. Very simple. Okay. In total, the total sales price is 9,000, my dear. The total cost is 4,000 plus 1,400. 5,400. over percentage of sales, 9,000. So equals, open brackets, 9,000 minus 5,400 over 9,000. That gives you 40%. So your URP will be equals 1,500 is the remaining goods into 40%. 600. Hold on. Don't take. Who has the inventory in hand? Who has the inventory in hand? Polestar had the inventory. Polestar had 1.5 million. Meaning technically it has to be eliminated from subsidiary. So URP eliminated from yes. Now do you see how I'm getting it? So going back, who is the seller? URP, how much is that? Minus 600. And I go to the top. Over here from current assets, how much? Minus 600. And then from inventory, I have to eliminate. I come here plus 600. Clear? If I add it to cost of sales, it will get deducted from my closing stock. Got it? Everybody, are you clear? That's done. Going further. That's entirely done. Polestar value is to value the NCI interest at fair value at the date of acquisition. This was deemed to be 3.6 million. Why is that? NCI goodwill. All items in the above statement of P&L are deemed to accrue evenly over the year unless otherwise indicated. Meaning for media acquisition, they want us to take the monthly basis. All the workings are done. What's next? Notes are done. What's next? There you go. By now, it has to be goodwill. So coming back, let's do goodwill together. That will be working 8. Number 8. There you go. W8. Goodwill on acquisition. For goodwill, what do I require? Investment cost. Don't forget, we took our investment cost on top. Immediate cash payment 13,500. And then 1,800. In total, 15,300. Are you clear? This is parents. And then there is and then we have NCI. Are you clear? Yes. And then we have NCI. NCI, how much is the investment cost? 3,600. 3,600. Are we clear? Yes. And then what do I take? Acquired net assets. What are the net assets? Share capital. How much is share capital? Share capital is going to be how much? 6,000. And then what do I take? Retained earnings. How much is retained earnings? How much is the retained earnings? How much are retained earnings? No retained earnings? No retained earnings. Okay. From the retained, we see the earnings if we deduct the profit. Super. Good one. Now, guys, now you need to think. Your retained earnings today is 12,000. That is as at the balance sheet date. but you're acquiring during the year, meaning this 4,600 is included in your 12,000. But it's a negative 4,600. If it's negative 4,600 at acquisition from 12,000, your retained earnings would have gone up, would have been up or down? Would be up higher. Meaning today, retained earnings closing is how much? 12,000, am I right? So for you to calculate your retained earnings at acquisition, how long has the acquisition been? 6 months. Listen to me very carefully, 6 months. So 4,600 is profit for 1 year. So profits 6 months equals 4,600 into 6 over 12. 2,300 I should add or deduct.
You should add.
I should add. I should add because from a higher retained earnings, because of loss, it would have come down.
Yeah.
Technically, if it's a profit, I will deduct. Are we clear? Superb. Well done, Shahid. Keep going. 14,300. Did I make any adjustments now to this? You go back at acquisition. What are my at acquisition workings? Okay, there's revaluation. Anything else? Except for revaluation, there's nothing I could say. Clear? Therefore, revaluation at acquisition is 0. And then there was a gain of how much? 2,000. Therefore, equals 2,000. My total is going to be 22,300 into how many percent? 75%. 16,725. Therefore, 1,500 minus 16,725. 1,425 negative goodwill. Listen to me very, very, very carefully. Keep your pens down. This is known as a bargain purchase. When the net assets are 16,725, I paid only 15,300. What am I doing? I am making a gain. I am making a gain. Since I am making a gain, parent is making a gain. Add to retained earnings. Meaning, if it is negative, listen to me, please listen to me. I'll give you time to write. If it is negative, there is no goodwill actually. Goodwill becomes 0. Goodwill becomes 0. We can't have a negative figure in the balance sheet. Are we clear? Hold on. Now, not just that, but I also have NCI. So 22,300 into how many percent? 25%. 5,575. So 3,600 minus 5,575. Even NCI goodwill is negative. Even NCI goodwill is negative. Okay, if NCI goodwill is negative, technically what is happening? NCI value is coming down. NCI value is coming down. In a circle, NCI portion is coming down means parent's value will go up. There's an inverse relationship. Therefore, deduct from NCI share of net assets. When it is positive, we add. When it is negative, we deduct. And when NCI share of net assets comes down, parents reserves go up. So add to parents retained earnings. My dear, it's a very, very, very crucial point. Are we clear? Everybody, okay. Look at the way I'm gonna account for it, okay? Now look here. My first thing is, I will not have goodwill at all. Therefore, my goodwill will be 0. My 15,300 is taken to calculate goodwill. So minus 15,300. I have my retained earnings. I come right below. To my retained earnings, I have a gain. So bargain purchase parent. So 1425, but it's not negative. It has to be positive. Okay. And then I also have what? My NCI negative would be NG. That was 1975, if I'm not wrong. 1975. Are we clear? Everybody out there, do you understand? Hold on. My 1425 and 1975 has to be accounted in my P&L. Therefore, I come here minus 1425 and 1975. Therefore, it comes down to 7,000. Understood? Everybody online, understood? Clear? Now that I'm done with this, what's next? NCI share of net assets. What do I take? Share capital. My share capital is at 6,000, no changes there. And then retained earnings. Now I'm going to get my retained earnings. So I'm going to get my total. Come here. Equals sum. Copy paste. So 11,300. Equals 11,300. Do I have anything else to take? Revaluation is evaluation reserve was 2,000. You can always go, and I would advise you to always go and connect it, link it. Only when you link it, you'll be, if you make any changes on top, it will be reflected. Okay, there you go. I've got my total 19,300 into how many percent? Into 25%. 4825. But what do I do? Negative goodwill. I have to deduct 1975. Therefore, my sum will be 2,850. Are we clear, everybody? Are we clear? Superb. I'm done with that. Next, what do I have? Consolidated working, whatever the working, consolidated revaluation reserve, because consolidated retained earnings, I'm going to take it as a balancing figure. Okay, we've studied that already. Guys, if consolidated revaluation reserve, okay, the only thing that I want you to do is, if parent has 0, we know for the fact that parent has 0 here, parent has 0, and subsidiaries, NCI and goodwill has not changed from acquisition. Now it's 2,000 at acquisition 2,000. If it has not changed, please don't do the calculation, take 0. Because there's not been any changes. It's going to be 0. Don't waste time in the exam. Are we clear?
Only if it has not changed.
Yeah, if it has changed, then please do the calculation. So NCI share of net assets 2,850. We're done with the question. No investment in associate, so that's going to be 0. Can we balance? $87,100. $87,100, but equals 87,100 minus 24,300 minus 2,850 minus 30,000 minus 30,000. 29,950 is my consolidated retained earnings. Are we clear? Are we clear? If you really want to, you can, because I'm doing it. I'm going to do the proof and show you if this is correct or not. Are you clear?
Yes.
Proof. consolidated retained earnings in the exam. I don't want you to do it. You take parents' retained earnings. How much is parents' retained earnings? $32,200. 200. And then subsidiaries today and at acquisition. Today, you can come down to NCI, 11,300. At acquisition, you can come down to goodwill, 14,300. So equals this minus this into 75%. So let's get our thing right. Brackets in 2250. So equals sum 29,950, 29,950 balances. Are we clear? Are we clear? Okay, latter part of it, very straightforward. I have this to do. Already done this minus this, 2,700 equals this minus this, 13,700. And then I have my profit after tax, which would be equals sum 10,700. But am I done? Am I done? NCI share of profits. NCI share of profits. NCI share of profits. What do I require? Subs profits. How much is subsidies profits? 4,600. So minus negative 4,600 into 6 over 12, 2,300. From this, adjustments. Well done, buddy. Adjustments. What are the adjustments that we made? All the adjustments for subsidiary that you made here will have an impact. Depreciation, URP. So depreciation and then URP. All those adjustments are allowed for subsidiary. So equals sum minus 700. Therefore, total is 3,000. In that, how many percent are we acquiring? NCI, 25%. We are acquiring 75%, but NCI is negative 150. Are you clear? Therefore, NCI negative meaning technically your parents' profit is minus 750 means so equals 750. There you go. We're done. If you get a question like this in the exam, it's a bonus. Entirely, you get 20 marks. It's a bonus. You know why? Because you have to prepare both. The volume of adjustments your examiner can test will be lower. The number of adjustments will be lower. Your examiner can't test a lot. It will be lower. Are we clear? Can you quickly copy it? Copy it and balance it. I'm sure until URP. Where did you copy? Until URP done? Goodwill is also done. Okay, you can copy goodwill.
It's test section, but it's
Guys, are we clear? Are we clear? Any doubts? Are we clear? Okay, guys, you can see the amount of questions that we have done. Guys, once again, we can do some questions on Sunday. Sunday morning from 9 to, sorry, Sunday or Saturday? Sunday, right? Sunday morning, 9 to 12:31. We can do some questions. And I think I have one more area to do with you. I have to do IAS 10. So we'll do IAS 10 on Sunday and let's do some more questions. And even next week, let's meet up, do more questions, and most probably with next week, I'm done.
the revision game plan.
Hmm?
It's a revision game plan class, right?
Yeah. So with that, we're done for the day. I'll see you all on Sunday. Yeah.
So from where can we get the past information?
Not now. If you're calling me, call me after 10 o'clock. After 10 o'clock, I should be fine.